Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to unpack your stock-related questions tonight are Rowan Williams from Nitrogen Fund Managers and Gary Booysen from Rand Swiss. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much, gent. We are waiting for Gary to join us. I do believe that he is having some technical problems logging in. Rowan, just looking at the biggest thing that investors digested today being there's Gary. Thank you, Gary. So just starting off the show, looking at the biggest economic data point that investors digested today being the February CPI print, surprising to the upside, coming in even more than the acceleration we saw in January, slightly though. The markets though seeming to take this in their stride, and I'm wondering why, Rowan.
Yeah, well, what we saw is the JSE did open up strongly this morning. Tencent was up in Hong Kong. And then actually through the session, it did lose all those gains to really close around flat. So we did see a change in sentiment when those numbers came out. Yeah, CPI is proving to be stickier than people had hoped. And both CPI and core CPI slightly ahead of expectations. And I think that just shows you, what a tough job the Fed has to try drive down inflation. There's been a moderation in inflation, but the sort of increase in the core CPI around this 3.2% range, it doesn't seem to be budging easily from there, which really speaks to a higher for longer narrative for interest rates. And I guess that's going to weigh, particularly we think, on emerging markets, including South Africa. As you said, the US markets have remained quite strong. I think because we've had a soft landing, what appears to be a soft landing, and dodging a recession, the markets have been strong there, but less so in EM. So somehow I think maybe the EM markets are hoping for a moderation of US inflation more so than developed markets.
Yeah, quite interesting, the divergence there that we have seen between the performance of the JSE and the US markets. Gary, I want to come to you. And it seems, are the markets in the US being driven by tech? I know that they had been beaten down over the last couple of days, but is it that they've come back today?
Also, if you look at the S&P 500, we up, call it, say 0.75%. So definitely looking strong. It does feel like this rally is still being fueled by the AI story. It's still all about tech, in my opinion. You look at some of the traditional, let's say, consumer discretionary stocks. You look at the broader universe of S&P 500 companies, and they just haven't done anything close to what the tech companies have done. And everyone talks about the narrow breadth in the market. They talk about the Magnificent Seven, but it's not just the Magnificent Seven. You can cast your eye just outside of that and just look at some of the other AI plays within the market that have just been doing absolutely exceptionally well. So I think it's really a single theme that's driving the US market at this stage. And as Rowan was saying, higher for longer narrative, that takes maybe a little bit of shine off tech, in the shorter term. I think we're still very optimistic on tech. Long term, I think there's incredible products and incredible services and incredible technology that's going to come to the market, and it's going to change the world that we know. But in the short term, with high interest rates, some of these valuations are looking incredibly extended, and a little bit of a wobble or correction I don't think would be surprising. So yes, still being driven that way, but for how long, we don't know.
All right. Well, let's mix finance with politics. There's a question here. I read the outcome of voting is not the point of interest, rather it is what happens thereafter. I think this refers to the fact that we believe ANC is losing their majority and a sort of coalition will take effect. However, the practical impact on state runnings are uncertain. What does the panel believe is the impact of this year's election on the market? What are the possible scenarios and the impact on equities? When it comes to election, are equities the main focus, or do you look at the bond market here in terms of the risk that elections have on the markets, Rowan?
Yeah, so it would affect the capital markets broadly, I think. Particularly the bond markets, because just in terms of the fiscal situation, I guess, and continuation of fiscal prudence. So that's probably where it would be reflected potentially the most, but equity markets as well, and particularly the domestic segments of the equity market, so the banks, the life insurers, the retailers. Some of the companies are rand hedge stocks, so the rand also could be a volatile, which would impact some of the equities differently. So yeah, bond markets specifically, and segments of the equity markets. I think it is creating uncertainty, and we are seeing it in the equity market, sort of very much a sort of up-down environment. Liquidity's been quite low, trading volumes low. So there's a bit of a wait and see. And as we see some of these latest polls showing quite a potentially dynamic situation, numbers sort of changing quite quickly. So I do think, yeah, we'll probably move sideways, the equity markets at least, until we get a resolution and some less uncertainty in terms of, yeah, the political direction that the country's taking.
Yeah. Gary, do you think that it's justified, you know, this impact that we are seeing in the markets, even in equities? Rowan was talking about low liquidity. Because you would think that, you know, the macroeconomic situation would kind of override that. Interest rates are expected to come down at some point. But also the ANC will still have, you know, a part of the pie there, even if we could end up with a coalition.
No, absolutely. I don't think, yeah, it's difficult to say. So, I mean, if you look at, so there's a wonderful investor note just around the polling going into elections, and kind of where the big challenges for South Africa are. And you can see, you know, ANC is losing support, but as you say, you know, you combined with the coalition, you know, we're probably not going to get a change of government. But that said, if you kind of dig into the polling data a little bit, and you can kind of see where the I think the real challenges that investors and certainly people that are being polled, you know, where the big issues are. And you can see, you know, 28% of respondents say that unemployment is the biggest problem in South Africa. That's the largest segment. That's closely followed by corruption, sitting at around 27% of respondents. That's followed 17% as load shedding. Then it kind of tails off towards weak leadership at 12%, crime. A failed political system comes in at 4%, and then poor policy is only at 1%. And you know, to really, I think, you know, to Rowan's point around the liquidity in the local market and the volatility, you know, if you look longer term and you're an investor in equity markets, bond markets, whichever vehicle that you're choosing to, elections actually don't have, you know, a huge impact on markets. You know, it's something that it creates the volatility during the period. And I'm not talking South Africa specifically. I think you need to look at every election individually. But if you look at, you know, elections broadly speaking, yes, they have the ability to change policies, and there's that volatility around it. But largely they are to an extent ignored. To say, you know, if we're looking at the US elections later in the year, and you know, just say if the Democrats come in or the Republicans come in, you know, is that going to mean that S&P is going to be down over the next year or up over the next year? There's almost no correlation historically, you know, specifically in the US elections around that. And I think it's, you know, remember, markets are forward looking. So a lot of this is already priced into the sentiment. So, you know, the people in South Africa, you know, we understand what the issues are here, and that is already reflected in market prices. So the only way that an election is going to change the longer term picture for financial markets is if there really is a surprise, a huge surprise result that we're not anticipating. If we get kind of elections in line with the polling data, markets are not really going to do anything. It's not something really to worry about. You're going to have the days of volatility. You're going to see the currency all over the place. But if you can look through that, there comes a trading opportunity for shorter term people. And longer term, I think you need to kind of batten down the hatches and just work with it.
Can you work with City Lodge, Rowan? That's the second part of the question. Can you work with City Lodge with all this risk?
Yeah, so I think interestingly, you know, how would it or wouldn't it impact, say, a company like City Lodge? So tourism has been very strong, particularly international tourism, and I think that will continue. I don't think tourists are too concerned about sort of the political outcome. It's not going to sort of impact the sort of overall stability of the business, the country. Yeah, unless, I guess, it does get ratcheted up in terms of sort of electioneering. We don't expect that to happen. So that is maybe something to consider. And then there may be a bit more in the short-term domestic movement in terms of, again, sort of electioneering and the IC moving around. So it could be a small bump in demand. So I don't think it would change the trajectory, but it may be sort of broadly positive, I would say, for trading in the short term.
Yeah, quite interesting. As I was looking at that chart today, City Lodge is down by almost 3%. I don't know if there was anything specific on it, or if it was maybe just dragged down by the subdued market sentiment today. Just considering also just how much optimism that there is on tourism. What do you make of what the share price has done recently, Gary?
Well, I think City Lodge needs to get occupancy rates a lot higher. Remember, there's a lot of operating leverage in a business like this. There's these big fixed costs. You've got these hotels that have to be serviced. You've got staff. You've got all the things that go into running a hotel chain. And you really need to get occupancies. As the occupancies increase, you get that operating leverage, and then you can see the share price recovering quite quickly. But we had the latest kind of company filing. Was out 23rd of February. There's nothing major that certainly not that I saw today that would have pushed the share price around. I think this is again to Rowan's point, maybe slightly lower liquidity in City Lodge at the moment, not as many traders, and I think part of that liquidity story is actually a structural issue. It's with the changes that we've seen to let's say the Reg 28 framework. I think a lot of asset managers have taken money out of South Africa. There hasn't been I think it's really has impacted our local market in terms of liquidity and price discovery is not what it used to be. So I wouldn't read too much into a big move today necessarily.
Yeah.
But yeah, as hopefully tourism improves and it is a competitive space, of course. I mean, you've got the likes of Booking.com coming in and all sorts of amazing, I suppose, technological innovations that allow you to allow people that are tourists or business travelers to go and select an Airbnb, for example, go on TripAdvisor, check out the rating, say, oh, that's 5 stars, I'll go there. I don't need to rely on this trusted brand like City Lodge to go and say, okay, well, at least I know what I'm getting. There's no risk to me. I just want to go and have a good night's sleep. Now you can kind of, you can assess that information, that kind of brand information that used to be the trust is not as required. So, I mean, we don't hold City Lodge. We don't cover City Lodge, but I would probably be cautious around City Lodge. I mean, I think, yes, maybe a weaker currency is going to promote more tourism and that you might see higher numbers, but are those tourists really going to be staying in kind of like business hotels? I don't know. It's not a clear call for me, and at the moment we don't hold it in portfolios.
Yeah, Gary, they are coming because now City Lodge is also expanding into more leisure. But of course, it's a wait and see game as to how much waiting that will be. There's an interesting question here. Is Sanlam facing headwinds? David Shapiro thinks so. Does your panel concur? I don't know, because their numbers seemed pretty good. And from what I picked up, it seemed that the headwinds were in Malaysia, if I'm not mistaken. Gary?
Yeah, so looking at Sanlam, I mean, they delivered a pretty decent set of numbers, and as I suppose list business goes, you would expect the rising equity markets and rising products to actually feed into their numbers. So if you've got a positive view on investment markets going forward, you should do well in something like Sanlam. Headwinds for Sanlam currently, I'll have to look at it in a little bit more detail. I haven't read the most recent update, but I think high equity markets, it's good for the insurance groups. Their floats obviously do very, very well, and that should feed into the share prices. At the same time, you've seen some of the let's say the life insurers and the more asset management focused businesses underperforming the banking sector. And I think as you kind of get to the situation where you get to the inflection point on interest rates and interest rates start to go down, you're going to see that starting to reverse, and you're going to start seeing the likes of potentially Sanlam, Momentum, 91. They're going to be outperforming something like, let's say a First Rand, a Nedbank, or an Absa.
Yeah. I mean, for me, what's interesting is also the growth in a new business there. When I spoke to the financial director, she did mention people's policies lapsing because obviously consumers are constrained, but saying that there's, maybe also a structural change since COVID where now people actually do go, and get insurance, and particularly life insurance. What do you make of Sanlam and how it's performing in this environment, Rowan?
Yeah, as Gary said, the numbers have been good. They have had tailwinds from rising equity markets and sort of better bond markets as well. They also have operations in India, which is a fast-growing economy, which are also doing fairly well. They've sort of restructured the African portfolio. That looks quite good. I think the one headwind they are facing is Capitec got their own life license and is taking over that funeral book. And we've seen from the Capitec numbers that part of the business is growing very strongly. So that is something that they're going to have to replace. They did announce the acquisition of Assupol, which is actually listed on the Cape Town Stock Exchange. So I think that will help replace some of that business and also strengthen their exposure to the Gauteng region. So I think they've been busy with their portfolio, well positioned. I think maybe the headwinds that they are feeling possibly are low consumer sentiment and low confidence, which is headwinds that a lot of South African businesses are facing. They're probably, I think, better placed because of the diversification than some of the other businesses to handle those headwinds.
Well, talking about sentiment, there's a question here. My question relates to sentiment. Typically, us non-learned folks look at a company like Shoprite and think, what a great company. I cannot lose. Notwithstanding that it is a great company and I happily own shares, the assumption is that market sentiment would have this running at a higher PE ratio to say Pick n Pay. However, on the flip side, Pick n Pay has taken a beating, so market sentiment would have discounted this stock. Assuming the current challenges are recoverable, would Pick n Pay not be a better bet at current levels? Gary, assuming that the challenges are recoverable, let's talk to that.
I think that thesis has been put forward for the last 20 years that Pick n Pay will eventually turn itself around. I think since I've been in markets, Pick n Pay has been talking about its big turnaround strategy, and we've yet to see it really dominate like Shoprite has. And I think that there's a couple of factors there. So I think the viewer, I think humbly saying as a novice investor, but is 100% spot on. I mean, you've got to look at the valuation of the underlying companies, and Shoprite is a lot more expensive than something like Pick n Pay, but you're paying up for quality. And I would kind of lean towards the Warren Buffett philosophy. You'd rather have a great company at a fair price than a fair company at a great price. So, you look at Shoprite, there's a couple of factors to it. So Shoprite obviously taking market share. We saw absolutely incredible results. And part of that is that 60/60 and that online delivery business, which is just absolutely miles ahead of Pick n Pay ASAP and, the other competitors. A lot of that comes down to the technology and just the supply chain management. This is not something that you can roll out by, getting a few developers together and loading an app and then hoping that you can hire some delivery drivers. It's an incredibly complex, incredibly detailed process, and from all indications, its competitors are nowhere close. The service that's being offered there is just absolutely incredible, and it's helping to gain market share. So at this stage, Shoprite definitely justifying the higher multiple in our sense. The share price performance has shown that as well. Remember with Pick n Pay as well, like there's a lot of moving parts to Pick n Pay at the moment. There's the potential listing of Boxer Group. You've had a management change up at the top. We've had the old CEO coming back in. They're raising capital. These are all things that, wonderful if it all works out. But like I said, we've kind of seen this movie many times before, and it hasn't really played out in investors' favor. So for now, we're buying the great company at a fair price.
Yeah. On your side, Rowan, do you bet on a turnaround on a cheap stock or a great story that does exist on a more expensive stock?
I think to some extent it's self-fulfilling. The difficulty that Pick n Pay has found itself in, capital constrained. Now they've created a lot of uncertainty around when they're going to raise capital and how much they need to raise, ballooning debt levels. Shoprite sees that from a competitive perspective and accelerates their expansion and really their quest for growing market share and taking market share from the business. So unfortunately, they, I think, are going to continue to really have one over Pick n Pay, and that's not going to change until they change the trajectory, until we see what that capital raise looks like and what the shape of the new group looks like. I think they are facing significant uncertainty, Shoprite taking advantage of that, and you're going to go where the momentum is, in the favor of Shoprite and certainly against Pick and Pay.
All right. A fundamental question, why do companies fall so much before the ex-dividend date? Gary?
Before the ex-dividend date, it's on the ex-dividend date
yeah.
that they fall. so they don't fall before. It's just a dividend coming out of the stock. So sorry, just on Shoprite, I'm just going to go back to Shoprite for a second. If you look at the last 12 months, just a quick. I was waiting for my data to update.
Okay.
If you look at the last 12 months on Shoprite, if you're actually looking in earnings terms at this stage, and you're looking at a metric as simple as PE, it's not that different in earnings terms to buy Shoprite versus Pick and Pay. So Pick and Pay is not as cheap as you think. But to answer the question around why does the stock fall on X date? So it falls on X date. So the last day to trade is obviously the day where you trade cum dividend. So if you had a 100 Rand share and it was going to pay out a 10 Rand dividend, the day before, you get to buy the share and you get owed the dividend. So that's great. So the share is still worth 100 Rand. The day after that, the X date, so there you now no longer trading with a dividend. What happens there is you are no longer going to be due that 10 Rand dividend. And if the dividend was 10 Rand on a 100 Rand stock, you would expect in an efficient market for that stock to fall exactly by 10 Rand. So the stock would then be trading at 90 Rand the next day because you're going to buy it without that 10 Rand dividend. And everyone who bought the day before is going to get a 10 Rand dividend. So it's literally as simple as that. It's not a complex concept. But yeah, we used to have a dividend stripping model where you kind of actually go and look and see if the dividends are being, are actually coming out efficiently.
Yeah.
And, there's a delay in the stock price movement, or traders haven't seen that the dividend that is trading X date, or no one's watching, which is particularly prevalent in a market with low liquidity. You can sometimes go and scoop a dividend, almost for free.
Okay. Well, thank you for that explanation. Rowan, I want to come to you with Sasol. Is Sasol a buy at this level? P ratio 3.4, dividend of 8%?
Yeah, so Sasol's been a really tough one because it's sort of on metrics like those that you mentioned, it's been screening cheap. And you would think Rand weakening, oil prices sort of being steady at current levels, that they would certainly be making good profits. But it's a very complex investment case. They're facing a number of headwinds. They're running out of gas inputs. Their coal supply hasn't been as anticipated. Chemical prices have been depressed. They've got a lot of challenges around potential carbon tax and needing to decarbonize their operations. And then if you look at the quality of the earnings, a lot of the earnings are not coming through in cash flow. So if you look at the sort of free cash flow multiples, they're much higher than that. So it actually doesn't look that cheap to us. And we feel the significant operational headwinds are creating extreme complexity for the management team, and they're struggling to cope with those. So we actually think, notwithstanding the very low levels and the uncertainty, we still don't see it as a buy at these levels. So it's almost too complicated to buy. But if I think management showed they had a strong grasp on the numbers, cut the dividend, likely to be cut in any case. They sort of announced that they are cutting it, so and improve the capital situation. Till we get confidence in that, we're not going to be confident in the investment case.
All right. Well, let's get to what you are confident on. Let's get to your stock picks. 30 seconds for you, Gary. 30 seconds for you, Rowan. Gary, what will it be?
Yeah, so I'm going to buy Nike today. So it's trading just a touch above $100 a share currently. It's really lagged the S&P 500 over the last little bit, and you can really understand why. We're in a macro environment where a consumer discretionary stock like Nike is going to be affected by less spending power by consumers as higher interest rates and high inflation kind of take their toll. If we do get into a situation where inflation, you can see it is coming down. Yes, it might have missed on this specific print, but I mean, we try not to take one data print, as a trend. And I think we are still expecting interest rates definitely to fall this year. That should lift, create a little bit of a tailwind for the company. It's an incredible brand. A brand gives you pricing power. It's a wonderful Steve Jobs clip that that's doing the rounds at the moment, explaining what a brand is and its trust. It's really a little bank account that every time you do something good, you generate trust, and every time you do something bad, it's a withdrawal from your trust bank account. And I think Nike has an incredible amount of trust in its brand, and that's what you're buying when you buy Nike. You're obviously paying quite a decent premium to it for it, because it is such an established company. It does have a couple of issues in China at the moment, but if you compare it to something like Lululemon, which has done very well, Lululemon is significantly more expensive. So for us, Nike hasn't had a run yet. Interest rates falling, US consumers still looking strong. I'd be picking up the stock.
All right. What are you picking up, Rowan?
We like Old Mutual. They came with a trading update today. It was fairly broad, but it clearly indicated strong trading and good market share, good new product sales. Also, they had been buoyed by rising equity markets and high interest rates. So it looks like it's still a 30% discount to its embedded value, and we do believe that presents value. And as we go past elections and our sentiment to the SA market improves, a good quality stock like Old Mutual should improve, and you should get a healthy dividend while you wait.
All right. Well, thank you so much, gents, for your time and for your analysis today. Appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Rowan Williams from Nitrogen Fund Managers, and Gary Booysen from Rand Swiss. Up next, The Close. Stay with us.
Thank you.